Good morning, everybody. It is August 23rd. I'm Kirk Spano, and I am in Meredith, New Hampshire, sitting at the town dock. So there are some people nearby. You'll get a little bit of background noise today, maybe a little sound off of the water and the nearby road as well. Really just want to cover one topic today as I continue my journey through the Northeast and through the center of the country. I will be writing several articles just about this trip and what I saw in the next week or two, as well as an article on the developing disparity. And really, it's not developing. It's been here a while, but it's getting worse and worse. The disparity between capital and labor. So I'll have that article out next week in time for Labor Day. And I want to cover just one really key topic. Because it's going to impact a lot of portfolios in the next, I'd say, 18 to 30 months. I'm not exactly sure if Crash 2020 is going to happen, but it looks more and more like it will to me. And I have a couple of reasons why and what people need to do about it. And folks who are stubborn are going to get clobbered and trail the market long term. So just as I've made a major change in my investment approach because of the rapid acceleration of the decline of use, or actually the growth of use of fossil fuels, the gradual flattening of fossil fuel usage in the face of a lot of supply that's available. I have walked away largely from being a major fossil fuel investor, although I'm trading it. Because the world's changing. The world's changing very fast. So I'd like to cover just a couple of things here with regard to where we need to be, how we need to play this over the short term to get repositioned. It's a move that we've been making all year, but we need to really accept that the world is changing faster than I think most people anticipated, and that there are certain places where we're going to want to focus our money. And whether you are a growth investor or a dividend investor, the underlying truths will remain the same, which is that the new economy, the gig economy, the alternative energy economy, the biotech economy, is really what is driving all economic growth. Not most of it, but pretty much all of it. And I'll give you an example right now. I'm in Meredith, and really the only cell phone service that has really fast internet is Verizon up here. So I'm on AT&T, and they have LTE, but it's not their fastest LTE. And therefore, you'll see on my screen that the details aren't real fine right now. So I'm not going to put up a lot of charts like last week. Last week I was in a slower internet zone as well. 5G internet development, things like that, clearly need to become better in America because other people laugh at us. I'm at a camp right now with an engineer from Verizon, retired engineer from Verizon, and then some people who travel extensively internationally. And really, Southeast Asia and most of Europe laugh at us for how bad our internet is. So the development of 5G is going to be one of those growth areas that we're going to continue focusing on, and that we have already bought some investments in. Let's take a step back right now. Unemployment revisions came out today. Remember back in the spring, I was telling you that there's something fishy about the unemployment numbers, and there's also something fishy about the oil inventory numbers. I don't entirely believe that we're getting the entire truth from some of the government agencies right now about what is going on. And I say that from a position not of being behind my computer, but really getting out into the world a lot and putting thousands of miles on my car to go and see things. I was in a town recently, Putnam, in Connecticut, I believe we were in, and I have some pictures that you'll see. There are parts of the country in the middle that if you're not attached to the hip to a big city or a tourist destination, you're still suffering in many, many of these places. And we've talked about the angst that President Trump capitalized on to become president. And whether he becomes, remains president or not, we'll see. But a lot of that angst still remains. There are places in America that are so far behind that you have to be able to understand that they're frustrated, they're getting left behind, and there's going to be repercussions for that. And if we don't get that, then we're going to have a problem. Well, that plays directly into the new economy, old economy theme that I've thrown out there. So let's take a look at these unemployment numbers. Back over on FA Trader in April, I talked about how the numbers were fishy and what I expected to come. Well, the conclusion on the investment side, and I don't know if you can read this or not, the conclusion in this FA Trader article, if I can get down to the conclusion, I may want to buy it. Whatever, the conclusion was that by 2020, 2021, we were going to see even more bifurcation, not only wealth inequality, but in the parts of the economy that were functioning well. The automotive industry in particular is in huge upheaval. We're already seeing layoffs. We're seeing factories getting changed over. And if we have indeed reached peak car, which I'm not sure I believe or not, but if we have indeed reached a point where the growth rate for automobiles being purchased is flattening out, just like other industries, then you're going to see massive unemployment issues. Because the auto industry is huge when you boil it down, not only from the car companies, but all the component companies. So I'm very concerned, as I've told you, about unemployment numbers. And to me, that is the harbinger of the next recession, if employment numbers start to go the wrong way. Well, what did we get today? We got a report that the Bureau of Labor Statistics overstated the amount of jobs that have been created in the last year and a half by 500,000. So the 223,000 jobs per month average for the last 18 months turns out not to be true. Looks like we only added about 185,000 jobs, which is basically average. There was no bump from the tax cuts. There was only a shift in wealth. So what does that mean for us as investors? It means that the consumer is not as strong as you think. And given that debt at the consumer level has been going up for about a year, we should be very wary of what that turns into a year or two down the road. If people are borrowing for lifestyle, that's a problem. And clearly it's going on. And there's more people who aren't in the labor force, which is the number that we have been watching. And why did it level off? Why did it flatten out, even though unemployment was dropping and employment numbers supposedly were going up? Because some of those numbers weren't true. And I'm not going to say anybody was lying, but I will say there's clearly smoothing going on, and it may have been motivated by something other than wanting to tell the truth. It might have been motivated by other factors. So what are we going to have to deal with in the future? See if I can find my mouse here. We need to understand the slow growth forever economy. And for folks who haven't been on this train with me before, demographics are the main driving factor in economics. More people, but more growth in economics. Well, the growth curve of population is flattening out. We're seeing fewer births, but with people living longer. And that means that there's a shift in how spending occurs. We have fewer people entering the middle class now that the major growth from China appears to be coming to a close. India should add people to the middle class, but they have, frankly, major bureaucratic nightmares over there, and the caste system is still alive and well. So we'll see how that goes in the next 20 years. But there is definitely major demographic reasons why we need to be concerned. Japan has got the oldest population of the developed nations. Europe is right there. China's right there. United States, as we've discussed, we have the millennials, so we're kind of neutral. which is, a relative gigantic advantage. In this slow growth forever economy, we can't just look at the past as prologue to the future. We have to consider that certain industries that require putting in $1 to get out $1.25, are going to struggle with their fixed expenses and with trying to create capital conditions to modernize and to pay people more and to drive growth. So we're going to see machine learning, we're going to see automation, we're going to see artificial intelligence continue to push into manufacturing and industrialization, and that's going to impact our investments. Many companies, and I was just talking to a tech guy yesterday, and I just shut up and listened to him because he got on a roll, and he was talking about how in the tech space, the small startup companies who are coming in with funding are doing well, and the giant companies are doing well, but the companies in the middle who have to comply with European regulations are throwing up their hands and saying, we don't have the ability to go get funding of startup, right? And we're not big enough to have the scale of some of the giant companies. Some of these companies are folding up their businesses or merging themselves or selling out or shrinking into oblivion. So there are problems throughout the economy because of the transitions. In the long run, does it all work out? Sure, it always works out. But the turbulence that we're going to get during these transitions is going to be major. And these old economy companies are going to have problems. If we see tech companies having problems, imagine what it's like to be a company that is capital and labor intensive in a world where your more well-funded competitors are able to automate faster. You do not want to be in companies that are having a hard time keeping up. As I've discussed, about 1/3 of the S&P 500, I think, falls into that category. And to me, that means that you're going to see a lot of stocks in the S&P 500, way over 100, maybe push at 200, that are going to really, really have dramatic problems in coming years. I've covered this before. Everything is changing. You have to dump the old economy stocks. In the next 6 months, maybe sooner, I think you really have to focus on getting out of those old companies. I told folks a couple of years ago, get out of General Electric. I was told I was wrong. I told people get out of cigarette companies. I was told I was wrong. Well, take a look at GE. Take a look at Philip Morris, what their stocks have done in the last 18 months or 2 years. They're falling off a cliff. There's a lot more companies that are going to go through that. So understand that is what is happening. Where's the growth going to be? Well, let's take a look. Go over here to ARC Innovation. And see if I can get my view here. A little bit of glare on the screen. There we go. So I'll go over to ARC Innovation here, and they have this great chart. 5 multi-trillion-dollar industries, innovation platforms, they call them, that we need to pay attention to. I was specifically talking to somebody about blockchain again yesterday, and I was talking to an investor in one of our groups. I don't know if it was margin of safety or fundamental trends, but another name came up. Companies that can connect blockchains are going to become very vital in the future, because part of the regulations out of Europe is that you have the right to disappear. You have the right to segregate your information out, and if you don't want it to be public, you should be able to get rid of it. That's one of the reasons why Facebook is bringing their own blockchain and currency into the market. That's what Libra is largely for. It's not that they want to create money, it's that they want to control the information. And, do you guys trust Mark Zuckerberg to control your personal information? Right? If I wasn't in a public place, I'd probably swear about that. No, there's no way I want Zuckerberg controlling my information. I'm talking to some tech people. They think he's a creep too. I think he's a creep. I don't think he has great ethics. I think that he has a vision of the world in which he is influencing it in a way that gives him power. And I don't like that about him. And I think that his attitudes, his outlook are frankly dangerous. And that's one of the reasons that I have a problem with Facebook as a stock. I think that their platform is questionable, especially if the regulators come for them. And I think the regulators are coming for them because you cannot trust what's going on at Facebook. And that's really all I have to say about that. I think that we have to find a better way of distributing information, controlling information than a like button that basically captures everything on your computer and everything about you, because that's what it does. So the regulations out of Europe, I forget what the initials are, general something or other, but the concept is that you as a human being have rights and are special and above the technology. I think that's an important concept, don't you? So as we look for places to invest, it's not going to just be technology. It's going to be the things that technology influences. It's going to be the power behind the investments. It's going to be where it helps consumers, where it actually improves standard of living. So when we really dive deep into these platforms here, artificial intelligence we've been talking about with Google, robotics, Rockwell Automation looks interesting, especially if it corrects more. Energy storage. We've been talking about this for the better part of a year now. The coal power plants are not switching over to natural gas. They're switching over to alternatives. And you get the articles and the old news about, well, we don't have enough metals and minerals and rare earth metals to do all the batteries. It's just not true. Not every battery has to give you instant torque in a car. Some batteries can just hold energy in a slow, basically a slow burn. Flow batteries using zinc oxide, zinc bromide, things like that, where you're not using the scarcest elements, are available. And because of the ways that we use energy, we don't need instant on, instant off. Everything doesn't have to be solid state. So if you have a slightly larger but cleaner battery that holds the power long term, the energy long term, and then transfers that into the more immediate power source, that's something that's going to develop. And I've talked about this just about exactly a year ago. I told you that Tesla was going to start doing their own battery technology, and it could have something to do with the zinc air batteries that are coming out. I don't know exactly how that's going to work, but some sort of two-piece or / hybrid battery is probably coming. So when you take a look at all of these things on this innovation platform, these are places where we have to find good investments. We need to find some of the bigger companies that pay dividends for our retired clients, and we have to find some of the growth companies. And we have to find total return that manages risk. This here is less risky than investing in those old economy stocks. Think of it this way. Would you rather put your money on a 20-something-year-old or a teenager? Or would you rather put your money on a 70 or 80-year-old? Think about that. 70 or 80-year-olds winding down, my friend. Doesn't mean that they don't have wisdom, but it means they're winding down. We need to find the good teenage companies. We need to find the good adolescent companies. We need to find the good young adult companies. Companies that are past their startup potential failure phase, and companies that are starting to put out big cash flows or even bigger cash flows. We need companies that are accelerating income so that we can take part in that growth. We need companies that are going to help change the world for the better and make some money doing it. What are those companies? We've got quite a few on the sustainable investing list. I've been waiting until after Labor Day to release the rest of the list. That'll come out over the rest of the year. I'm going to tease some of the stocks, but I don't want some of these names getting out before I'm ready to buy them because I don't want other people cherry picking these companies ahead of my subscribers and my clients. So I've got about 20 names of stocks, of companies, that I'm not sharing yet. And when these companies start to get to the prices where we want to buy them, I'll start dropping them onto the very short list, sustainable growth list. The dividend stocks, those are bigger companies. Those are more well-known. So those are already on the list. But, for now, just keep in mind that the world's changing. It's changing quickly. Use the rallies to sell your old economy stocks. Look at the growth rate. If the revenue growth rate on a company has been flat for a number of years or it's been flattening, if they don't have an avenue to increasing their revenues, if they're putting in $1 to get $1.25 back, you probably don't want those widget companies. You want companies that are very scalable, that are asset light. That's a term that you've heard in the news lately. I've been talking about it for a few years. Subscription-based revenues, right? Sierra Wireless, Disney, AT&T. People thought I was silly a year ago for wanting to buy AT&T in the low 30s. Well, now it's 35, and you're still collecting that 6-7% dividend. AT&T is going to go into the 40s. I have no doubt in my mind. I'm pretty certain they're going to break into a new higher range because the revenue that they're going to get by adding the subscriptions is going to be massive. And none of these companies are going to be dumb enough to, and we can tell by the way they're doing their programming, they're not going to be dumb enough to just run at deficits. Why? You take a look at the program at HBO, at Disney, at Sony, which it hasn't been bought yet, and I think is a company that's in play. Apple, right? Apple just jumped into the fray. You take a look at how this revenue gets generated. Take a look at Netflix. Netflix doesn't have a very deep library, really, but they have several shows per season that people want to watch. And for $9 a month, I'll subscribe to Netflix, and I'll subscribe to AT&T, and I'll subscribe to Disney, right? Why? Because I need my sports, and I want to watch Stranger Things, and I want to watch, Tom Clancy's show. I don't even know what it's called, but I watch it. And I might want to watch two or three things on Amazon, 2 or 3 things with Warner, 2 or 3 things, with HBO, with Netflix. These subscription-based revenue models are going to make a lot of money. And consider that the average person probably was spending $100 to $120 a month on cable. That's $100 to $120 a month now that they have to spend on subscription revenues. Subscription content, I should say. Also, we want to take a look at the companies that are in 5G and have service fees that are going to come with deploying their hardware. So hardware companies get their hardware out there, and then they charge an ongoing fee, right? That's a nice model. Those companies are all out there. We don't want to be in the widget-making industry where it takes a lot of capital and a lot of labor to build things. Use the next several quarters, sooner is better because we don't know when things turn over, to get rid of your old economy stocks. All right, I'm going to let you go here today. It's going to be a quickie, and look for the articles over the next several months, and consider what you really believe about the way the world is going. Are we going to go back to smokestacks? We're not. Are we going to go back to coal? We're not. Oil and gas, they're at the very beginnings of the end, right? We'll use gas a long time and oil a long time, but not nearly in the amounts that we are. What is climate change impacting? What is AI impacting? What's going on in biotech? Think about these things. The world moves forward, and we have to be part of that. And the first step is get rid of your old, debt-laden, widget-making, parts companies. Enjoy the summer. I'll get a peace out next week when I'm back in Milwaukee, back to the high tech, and we'll do a Labor Day show next weekend. Take care.